Okay, today's bank is Columbia Banking System Incorporated. It is headquartered in Tacoma, Washington. They're based in the Pacific Northwest, mostly Washington and Oregon. But back in 2023, they acquired Umpqua, which was about half their size. So they've increased their size by about 50% probably through the acquisition. And so that added several branches throughout the Northwest as well. So they entered a few other states, but they've grown recently through acquisition of that bank. And looking at their stock page, we can see the trajectory of the price, and it's taken the same shape that we've seen for many different banks that we've looked at so far. And we've seen that some banks will have an up run right here, and some will have sort of a flat line. And so this bank has had a flat line over the past year to date. It's a very, very big bank, $4.3 billion, and a PE ratio of 8.4. That's a really cheap price for earnings. That's about an 11.9% earnings yield, which is a really good earnings yield. And also a dividend yield of 7.14%. That's interesting. We will see a little bit more once we dive in how sticky the earnings are and whether this price makes sense given the risks that are in place. But if we go to the statistics page, we can also see the price to book ratio, which is also very, very low. So even last quarter, it was 1.2. Now it's down to 0.85. We normally see somewhere between 0.85 and 1.05. So 0.85 is a little bit on the low end of price to book ratio. So we could guess that the price of the bank is relatively cheap to the earnings and its net assets. But of course, there might be a reason for why it is so cheap. But we can see that they do have a pretty good return on assets. We typically see somewhere between like 0.8 to 1.05%. So 0.92 is right in the middle of the average of what we see. Pretty good return on equity as well. So it seems like it's a really good, profitable bank, and perhaps at a cheap price on its earnings. So let's dive in and see if we can figure out why that is the case and whether the risks can be mitigated by a cheaper stock price, if there do end up being major risks. So down in the balance sheet, we see $2.2 billion of cash. That is about average, about 4%. As far as the securities go, we have a little over $8.5 billion. And that's about 17%, and that's about average as well. The loans are about 72% of the assets, and that's about average as well. So we have a very average allocation to cash, securities, and loans. Very average bank. And then we've got about $1 billion of goodwill, and that seems like a lot on the face of things, but it's actually only about 2% of the assets. Most banks have somewhere between 1.5%, so not so too far outside the range. We've seen some banks with a lot more goodwill as a percentage of assets, but this bank seems to have a little bit of an elevated but not so egregious. So based on this, I could see there being a very average return on assets, at least in the net interest income, or at least the interest income. On the liability side of things, we have about $13.8 billion of non-interest bearing deposits, and we prefer to have as much non-interest bearing deposits as possible. And this is 29% of the total liabilities, which is above the range we typically see. We normally see 20 to 24%. So 29% is fantastic. That means they have a funding source that doesn't cost them anything, presumably. The amount of debt that they have is a little bit on the high side. It's about 9%. And of course, this is the higher funding cost. Right now, typically somewhere between 5.5% we would normally see, whereas the interest-bearing deposits would be somewhere around 3 to 4%, depending on the timing of when they were originated. So it almost seems like the interest expense would be maybe an average amount, maybe on the low side of things, given that they've got so much non-interest bearing deposits, which is fantastic. So, and that might be why we saw on the Yahoo Finance page that they've got such an average return on assets, return on equity. But we can go down to the income statement and see if that's the case. So we see interest income of $684 million. That is about 5.7% of assets. That's a pretty good yield. It's mostly because there's a good yield on loans, as well as a pretty good yield on securities. The loans are yielding a little over 6%, which is a good yield for this quarter, as well as 3.8% on the securities, and that's really good as well. So it leads me to believe that the loans and securities perhaps repriced pretty quickly, or they repriced recently to allow them to be repriced into higher interest rates than perhaps were there a long time ago. So 5.7% earnings yield on assets, that's pretty good yield. It's right around where we've seen for the last several banks that we were looking at this 10Q. So a bit average for right now, but on the high end if you're comparing to yields over the past year. As far as interest expense goes, we've got $198 million interest expense on deposits. It's 1.9%, which is actually really not really low, but is on the low end for what we've been seeing for most of this quarter. So, and even about average for what was happening over the past year as well. So that's a pretty good interest expense, and it's partly because, as we saw, they have a lot more non-interest bearing deposits, but also a little more geared toward debt than to deposits. So then coming down to the debt, if we add all these together, this gets to $63 million, and that's about 4.96%. And that's about the rate that we would expect for FHLB borrowings currently, so that's probably about right. It's on the high end of the most over the past year or so, but for the recent quarter, we've been seeing a lot of debt yielding a little over 5%. So, but all that together gets us net interest income of $423, which is 3.24%, which is a fantastic net interest margin. So we normally see somewhere between 2.8 and 3.1, something like that. And so 3.24% is a fantastic yield on the net interest earning asset. And I think it's, as what we were discussing, they've got a pretty average asset side of the balance sheet, but the liability side, there's a lot more non-interest bearing deposits, so that allows them to have a lower deposit cost, and so then an overall lower funding cost, which is giving them a really good margin. So that's fantastic. The non-interest income is $50 million. That's about 7%. That's a little bit on the low side, but they have some gains and losses on equity securities, which could really go either way, right? So last year was good. This year was a loss. So somewhere between 50, 54 million is perhaps the norm for a quarter, but $4 million doesn't move the needle that much. So we left it there. If it had ended up being a lot of money, we would pull it down out of the income statement to put it in a position where what's the recurring net income, right, is what we're trying to achieve here. Anyway, we didn't feel like it was that material, so we just kind of left it where it is. So 7% yield is about below the average. We typically see 10 to 14% of the revenue as being non-interest income. So a little bit on the low side, but as we saw, they're making really good money on the interest income side or net interest income side. So maybe that doesn't harm them that much. And then in the non-interest expense, we've got $287 million. And that is 39% of revenue, so that's on the low side. We normally see 41 to 47%, so a 39% is a really good non-interest expense. So not only do they have really good net interest income, but they've also got lower non-interest expense. So that together gives them a net income of $124 million, which turns out to be a return on assets of about 0.95%, which is a very average amount. We normally see 0.8 to 1.05. So 0.95% return on assets is very average. So taking that and annualizing it, for example, multiplying by 4 and dividing by the market cap of $4.2 billion gets us about an earnings yield of 11.75%. And that's really, really good right now. We typically see something like 9 to 11% on the earnings yield. So they're earning 11.75% is a very good yield on their earnings. So it'll be interesting to see whether there are any other risks that are within the bank that is pushing the stock price down to where it gets an above average earnings yield. And so once we dive into things, we will see if that's the case. So in the recent merger, Columbia, this bank, acquired UHC, which is the holding company of Umpqua Bank, and then Columbia State Bank, which was part of this holding company that we're analyzing right now, basically merged into Umpqua Bank, and then Umpqua was the surviving bank. So going forward, it's going to be Umpqua, and even on the call report and things like that, it is Umpqua instead of Columbia State Bank. So that happened in, I believe, February of 2023. So they have a lot of disclosures related to it, but it's not really necessarily relevant to what we're looking at now. If we wanted to compare the first quarter of 23 to the first quarter of 24, it would be relevant because there would be 1 month of the combined bank operating in the first quarter of 2023, and then in 2024 there would be 3 months, the entire quarter of the combined bank. So there would be some differences there. And so if we get down into things and we see that there are big increases in, for instance, non-interest income or non-interest expense, then those things would be a result of having more months of the combined bank than there were in the prior year, right? So just keep that in mind. So we can skip on past this stuff and get down to the securities. You can see there are 8.8 billion of available for sale securities and 3 million of held to maturity securities. So they're mostly all available for sale, and so then they would be at fair value, right? There is a significant amount of unrealized losses currently, but that's not unusual for banks currently. So not necessarily something that we should ding them for. At least if our investment decision is based on comparing it to other banks, which is the case right now. So about 70% of the securities portfolio is mortgage-backed securities, which is pretty average. That's pretty normal. And then the remaining are about 12% of munis and 17% of treasuries. They seem to have a lot more treasuries than the normal banks, so maybe they're a little bit more risk averse. Only 12% are munis and would relate, at least have some kind of risk as a part of them, right? The mortgage-backed securities and the treasuries are assumed to be riskless due to being explicitly or implicitly guaranteed by the U.S. government. And so I don't believe and I don't think that it would make sense to have some sort of an allowance on the portfolio, or at least a material allowance, right? And they more than likely don't, right? So they say that the change in fair value of the banks or the securities where they have these really high losses are due to interest rates and not necessarily credit quality, so they don't have an ACL on the securities. So I think that's fine. We can also see the term structure, the duration of the securities. So about 48%, so about half of them, mature in longer than 10 years. So we can see there's pretty long durations in the securities, so that would be a risk as far as interest rate repricing risk goes, which isn't that unusual as well. The 48% is higher than we would normally see. There's actually only 1% of the securities due within the next year. So that is really, really low amount. We normally see at least 3 to 7%. So when we're calculating our interest rate repricing, we're looking at the next year, right? So basically none of the securities reprice within the next year. So there's not getting any benefit to where if interest rates went up, the securities would not get to participate in higher interest income. So that's the risk here that we would be taking with this securities portfolio. But once we get into looking at the repricing of the securities, loans, debt, deposits as a whole, we'll be able to see perhaps their loan portfolio reprices quickly, and that would supplant the slow repricing of the securities. But we'll see once we get to that. Anyway, so here's the loans. So as far as the allocation, we have most of it to commercial real estate and to C&I type loans, and then there are some residential real estate as well. So if we added the commercial real estate, which is it's non-owner occupied plus owner occupied, it's about 31%, and then the multifamily is 15%, and then the construction is about 5%, and then the C&I, all this together gets us about 26%. So these are all pretty average percentages. The C&I might be a little bit higher, but very average for a commercial bank. Yeah, so we might expect the yields and the risks to be average for the loan portfolio as well, which we did see in our first look at the income statement, that the yields on the loans are a little bit on the higher end, or at least a little bit better. So maybe there is some additional risk within the loan portfolio that's allowing them to earn that higher amount. We'll see that once we dive into more of the past dues, non-accruals, classified loans, that type of thing. And so coming down to the allowance, we can see there's about $414 billion allowance. There is a reserve for unfunded commitments of $23 million, which gets us up to $437. We're just going to look at the allowance on the loan portfolio itself and exclude the unfunded commitment. So $414 million is about 1.10%. That's pretty average, if not on the lower end. We normally see about 1.10 to 1.26% of the allowance as a percentage of the loans. So they have a pretty average reserve here, if not a little bit on the low end. So we can take that into account when we make assessments of the quality of the loan portfolio itself. We can see that the past dues plus non-accruals equals about 253 million. That's about 0.67%. That's pretty average. We normally see somewhere between 0.5 to 0.8%, so very average amount of past dues plus non-accruals. Non-accruals it's below the average, so 0.26% of loans. Non-accruals is a pretty low amount. And then collateral dependent loans is about 150 million, which is 0.4% of loans. That's a pretty average amount as well. There's not been very much TDRs over the past quarters. That's about 35 million. That's really, really low as well. We've seen a lot of banks having a lot of TDRs lately, but this bank has a pretty low amount, so that's great. It almost seems like the credit quality is pretty robust. But now we can dig into the classified loans and see if that's the case as well. So if we add up all the substandard and loss loans, it's a little bit difficult to piece this together because they have several different tables with different dates and different categories of loans, etc. But if you pull all this together and you add up all of the classified loans for this year, it comes to about 591 million, which is about 1.57% of the loan portfolio. So that's a little bit on the high end. We normally see somewhere between 1.10, 1.7% of their loans being classified, and this bank has about 1.57% of their loans classified. So that's a really high amount. It's interesting that there would be such a high amount when there's such a low amount of past dues, non-accruals, TDRs, collateral dependent, etc. But this classified allocation consideration it identifies the loans that have a particular identified problem that is going to make it to where it's more likely that the loan will not be repaid in full. So it's more of a forward-looking thing, whereas the past dues, the non-accruals, etc. have already happened, right? They're already not paying the loan back. So this is almost a foreshadowing of down the line there could be a time where they're going to have to increase the provision or write off loans, and it could be to the tune of $591 million, and I don't believe that that would be the case, but because this isn't loss given default. This is the entire loan balance in this number. So if they were to default, then the bank would get paid most of the loan back, right? Or at least we would hope. So most banks have a reserve that equals at least about 90% of the classified loans. In this case, the bank has 70% of classified loans reserved, and that's on the lower side. So we saw that the classified loans as a percentage of loans are on the higher end, right? 1.57%, that's a lot. And the reserve is on the lower end, about 1.10%, on the lower end of the average bank. So it seems like they should have a little bit larger of a reserve. So if we were to put some numbers on that, the current reserve is 414 million. The classified loans are 590 million. The difference between those two is 176 million. So if we consider that in light of how much the bank makes per quarter, which over the past quarter they made 124 million. So currently we have a net income of 124 million per quarter, which gets us a return on assets of 0.95%. In order to stay within an average range of return on assets, we need it to equal at least about 0.8% return on assets, right? And so that place is about $100 million a quarter. About $104 million a quarter. Earns us 0.8% and keeps us within an average return on assets figure of 0.8%. So that means currently we have 24 million or 124 million, and we could have a decrease of net income to 104 million and still be considered an average profitability bank, right? So that's about a $20 million reduction. So if we had to increase the provision by 176 million, then we could reduce the net income by 20 million, and that would take us about 8 quarters to shore up about 8.8 quarters, a little over 8 quarters to shore up the provision while keeping a net income within an average range. And I don't think that's doable. I feel like it would more than likely need to happen sooner, and then that would put the bank within an average profitability that's below average. It would put their profitability below average. So I would say that the credit risk that we have in place currently is maybe higher than what I would prefer. I mean, to get the reserve up to the place that I would like to see it would wipe out an entire quarter's net income as it is here. I feel like that's too risky. But we did see that the bank is earning a higher yield than what an average bank would be yielding. So that might be compensation for this risk that we have in place, right? We can consider that once we get to the end of the analysis and look at all the risks and the profitability together. But as it is, that's something we'll have to decide at the end, right? So anyway, let's keep going. Some goodwill. All right, borrowings. So what's interesting, they have, if you remember, there was 3.9 billion of borrowings on their balance sheet, and all of that comes from FHLB as well as the Bank Term Funding Program. And then they also have some repurchase agreements for some of their depositors. It talks a little bit more about this once we get down to the MD&A, so we could probably touch on it a little bit again once we get there. But there's about 400 million of trust preferred securities, which are at floating rates based on SOFR. And we have repurchase agreements of about 200 million. Those also reprice relatively quickly, perhaps overnight. And then the 3.9 billion that's coming from the FHLB and the Federal Reserve's Bank Term Funding Program. All of those things, at least by looking at the call report, we can tell all reprice within a year. So their entire debt side of their balance sheet reprices within a year, and at that point it will more than likely reprice at higher interest rates. Currently, the trust preferred securities, which are at floating rates, are yielding somewhere around 9% I believe. So it could be the case that when FHLB reprices, it could be repriced at higher yields close to that. So that's the risk that we take on the interest rate repricing risk, right? And once we get down to that part of the MD&A, we will be able to look at the loans and securities and debt and deposits in conjunction together and decide how that repricing risk looks from an asset and a liability side. So let's keep going. They have about $11 billion of commitments, and that is a pretty average amount. That's about 30% of loans, which is a little bit on the high end, but not too far outside of the normal range. So you could look at that as a risk, right? Like what would happen to liquidity if they all of a sudden had to lend $11.2 billion. I think the bank could handle it, but it also is sort of a signal of growth, right? It would be great if the bank were able to lend $11.2 billion, right? So as is most things with the bank, there's two sides between yield and risk, right? Liquidity. Anyway, so going through some of this stuff, one thing to note is they do have quite a few legal matters going on. It seems like a few of their customers perhaps were perpetrating Ponzi schemes, and now the bank is being sued by the people whose money was taken. And that is one of the lawsuits. The other one, I guess maybe there were two lawsuits related to Ponzi schemes, but there's also one related to Move It, which is a pretty common thing across banks, is where there was a data breach within a third-party vendor, and a few of the banks are getting sued by customers who lost their data or had some kind of issues with that. So that's the case with this bank as well. So there's a lot of risks here from a litigation standpoint. They've accrued $6.9 million, which really doesn't seem like enough money. It doesn't really seem like very much money at all, especially when you're reading through this and you start pulling out all the numbers, $250 million, $429 million, $110 million, $386 million. And then these guys have accrued $6.9 million, right? And of course, I'm not an attorney and I haven't looked at these cases in detail, and so I can't put an estimate on how much they're going to lose or win or whatever happens. So at this point, we just have to consider that as a risk, right? But what more than likely is going to be the case is that they would definitely have to pay a lot of legal attorney fees related to this. So more than likely, there would be a lot more money on attorney fees than $6.9 million. So that's something to consider as well once we start trying to decide whether the earnings the bank is making is enough to offset some of the risks that we are entering into, which we've already identified some with the loan quality, right? So let's keep going past that. I read through the derivatives. There's not any that are under hedge accounting. So there's no cash flow hedges. There's no fair value hedges. They're more or less rate lock commitments, back-to-back hedges with their customers and a correspondent bank. So nothing really we typically adjust our timing of interest repricing and loan maturities, security maturities, debt maturities, that sort of thing. We adjust those with the swaps to help us identify what's the interest rate risk, given that the swaps will sometimes fix variable rates or make fixed rates variable. So we use them to adjust that. And so in this case, since there's not any hedge accounting derivatives, there's nothing for us to do related to the derivatives. Fair value adjustments. we're comparing the carrying amount on the balance sheet to the fair value amount. And typically there's a difference between with the held to maturity securities, but as well as the loans. So there's not a whole lot of held to maturity securities, if you remember. So there's a small difference between them, but it's not huge. And then loans, there's a pretty big difference. It looks like about $1.5 billion. So if we decreased the carrying value on the balance sheet down to its actual fair value, that decreases the equity by $1.5 billion, which is about 30%. And that's a little on the low end. So that's really helpful that we don't need to decrease the assets so much. And that's mostly because they're all being held as available for sale. Whereas a lot of banks will have held to maturity securities here, which will be at a difference of fair value and carrying value. So we would have to adjust those down. So when you're looking at price to book ratios, they can be skewed one way or the other depending on whether the bank has held to maturity securities or available for sale securities. So something to pay attention to. And that's why we adjust things to fair value to put all the banks at apples to apples, right? So when we do that and we subtract the fair value of liabilities from the fair value of assets, that gives us a fair value of net assets. And then we also exclude the goodwill, which was about $1 billion. So that gives us a tangible net asset at fair value number. And if we compare that to the market price of the bank, or the market cap's about $4.2 billion, right? And so the tangible fair value of net assets is $1.9 billion. So basically, a $4.2 billion market cap divided by the tangible fair value of net assets of 1.9 puts us at a multiple of about 2.21, which is a little bit on the high side. We typically see somewhere between 1.5 and 2.5. So 2.21 is sort of within the average range, but it is a little bit high. Most of the banks that we've been coming across lately has been around 2. So it's on the higher end. The market price for the bank's net assets is a little bit higher, but you could call it average as well. So also taking into account the $1.9 billion of tangible net assets compared to the fair value of its assets gives us a ratio of about 3.9%. And you can take that as a capital adequacy metric, right? So their assets are supported by about 3.9% equity. And most of the banks that we see right now are somewhere between 5 and 7%. So 3.89% is a pretty low ratio and could be a signal that the bank might not have an adequate amount of capital, or at least as much capital as what the average bank might have. All right, so let's keep going here past the fair value footnote. And that might be the end of footnotes. And now we're down to the MD and A. So there's a lot of information here about the acquisition and some of the things that have changed from year to year. We're going to skip past most of it. You can see here a lot of the statistics that we've already looked at. So 0.96% return on assets, return on equity also fairly high. You know, in March 2023, there were a lot of merger related expenses, right? There's also been some throughout the years, so a little bit lower return on assets and also losses, right? But in this quarter, they're maybe finally getting back into the normal swing of things. I believe there's a little bit of merger-related costs, which they note throughout here, but it wasn't a lot. I believe it was maybe $6 million this quarter. So not really a whole lot that would change the metrics or our decision. I don't think so. We didn't necessarily pull them out to normalize the earnings, but if they had been a large amount, we might have. And then we've got it looks like some capital ratios here. Tangible common equity, 6.63%. I believe that's a really, really low percentage. Yeah, we would normally see something like 7.65% to 8 somewhere between 7.5% to 9% in most cases, but this is 6.63%, which is a metric for capital adequacy, right? And we already saw that whenever we converted things to fair value, that perhaps their capital might be a little bit on the low side of what the normal bank might have. And that seems to be the case from this metric that they published as well. Of course, this is a fairly large bank. Our population has a wide range of sizes of banks. Maybe the average size bank, right, would have the average common equity ratios. Larger banks are better able to operate with a little bit more leverage, and perhaps that makes it to where it would be okay to have that low of a ratio, but it is still outside of the range that we would normally see for our average bank in our population, right? So just a risk for capital adequacy once we get into looking at the full picture. But now we come into the table that shows us the yields that they have on their various assets and liabilities. We can see the interest earning assets of 5.69%. That's a really good yield on the assets right now. It's probably about what we've been seeing over the past, while we've been looking at all the 10Qs that are coming out. Over the past year, it would certainly be a high amount, but within this particular quarter, it's probably about an average amount. We can see the loans earn a pretty good yield. The securities also earn a really good yield compared to what we normally see. For a lot of the securities on the balance sheets of banks that we've been looking at, they've been around 3%. So they're earning pretty good yields on the assets that they have in place. And they also have a pretty average allocation to the various types of assets. So an average allocation to cash, average to securities, average to loans. So, average or better yields against the average allocation puts them at an average or a little bit on the high range of the average of yield on earning assets, which is fantastic. And then also the yields on their deposits, it looks like, is right around maybe 2.5% if you take these three categories together on a weighted average approach, which is about average for this quarter as well. Time deposits, maybe so as well. So interest-bearing deposits puts us at 2.88%. But if you remember, they have a very high percentage of non-interest-bearing deposits. So about 30% of their liabilities is non-interest-bearing, which aren't taken into account here, right? But they are taking into account interest margin. So even though they might have an average cost of interest-bearing deposits, since they have a larger allocation to non-interest bearing, it makes it to where the yield on the overall liability side of the balance sheet is lower, right, as a percentage of all the liabilities. And also we can see the yield on the debt. So we've got 2.2% on the repurchase agreements and borrowings 5.26%. That's about average for FHLB, Federal Reserve, that sort of thing. We can see the part of this is the trust preferred securities. All of this is the trust preferred securities. They're yielding about 9.39% right now, and that's because they're at floating rates, right? It would be SOFR plus a spread. And so once these borrowings reprice, they could potentially reprice at a yield that's almost this amount, if not that amount. So that's the risk that we're taking in the interest rate reprice risk, which we'll talk about later. But as it is, 3.52% interest margin, that's just fantastic. we normally see something like 3%. So these guys are earning big time net interest income, partly as a result of having a lot of non-interest bearing deposits, but also pretty good yielding assets, right? So that's fantastic. And keeping on going, moving on, we've already talked about a lot of this within the footnotes of the financial statements. So we can sort of get through this and get to more of the liquidity, capital, those sort of disclosures. All right, so here we go with the liquidity. If we read through this, we can see that they've got about $13 billion of funds that they could borrow from the FHLB and Federal Reserve. And they also talked a little bit about how much cash they have, etc. So we've sort of compiled all that and also made some of our own calculations based on the call reports as well as information from here. And so as far as their on-balance sheet liquidity, they have about $2.2 billion of cash, which we remember is about an average amount, about 5%, I believe. And the unencumbered securities come to $3.5 billion. So they have about 60% of their securities pledged. And the ones that are not pledged come out to about $3.5 billion. So that represents either securities they could sell or they could pledge and draw money down on, right? So all that together gives them about a $5.7 billion on balance sheet liquidity, and that's about 14% of deposits. So that's a pretty average amount. We typically see somewhere between 13 and 17% of deposits of on balance sheet liquidity, and these guys have 14%, so it seems like they've got a pretty good amount of on balance sheet liquidity. And so then they've also pledged, so they've pledged about 60% of their securities, and they've pledged about almost 60% of their loans as well. So that gives them some additional collateral that they can draw down on with FHLB or the Federal Reserve. And so they've also got some money that they can pull from correspondent banks, which you see 600,000 here. So that gives them an extra boost. So the on-balance sheet plus off-balance sheet liquidity, which would be this, gives them almost $32 billion that they either have on the balance sheet or they could draw down if they need it. And that's about 75% of deposits, which is a pretty average amount as well. And you could even compare that to uninsured deposits, which puts them at an average amount. If you compare it to equity, it puts them at a pretty average amount as well. So I would say that they've got a pretty good liquidity position, very average liquidity position, which is fantastic. And coming down to capital resources, this tells us a little bit more about the regulatory ratios. So they actually have really low regulatory ratios, 7.72%, 977, 977, 1195. All of those are below what the average bank has. They're above what the regulators require them to have to be well capitalized, but they are very low compared to most banks. So part of that could be due to what we've already seen, where perhaps the capital is lower than most banks have, either on a fair value basis or even on the carrying amount. But also a lot of their loans end up being commercial and commercial real estate, or C&I and commercial real estate, so those get a little bit higher risk rating within here. So within these ratios. So these ratios are really low, and that almost makes me think that given that there's so much evidence for lower than average capital. For instance, when we converted it to fair value and compared to the assets, but also the tangible common equity ratio, as well as these regulatory ratios. It seems like, it doesn't seem like, it is the case that they have lower capital amounts than the average bank does. So we would just have to consider that in the face of the other risks that we have, as well as the profitability of the bank and the price that we're paying for it, right? So on the interest rate risk side, we can see here that it looks like they are very, very neutral interest rate risk. If interest rates go up 300 basis points, their net interest income basically doesn't change at all. No matter where interest rates go, their net interest income does not change very much at all, according to this projection. We've done some of our own projections, and so it seems that, not to say that their calculation is incorrect, they know it more than I do, but there's a very small changes in this, but economic value of equity, there's some big changes that are more in line with, typically when we see these size changes, we would see bigger changes in the net interest income, right? So not sure what would cause the difference, but they know better than I. So anyway, all that to say that it appears from here that they might have a very neutral asset liability risk, and that would be awesome. That's what we're shooting for, right? So if we look at our calculations, we get a very average, what we call our repricing ratio. So we're comparing how quickly do the assets reprice over the next year compared to how quickly do the liabilities reprice. And we get a pretty low amount. It's within the normal average range of most banks, but it's a pretty low amount where it would be where it's a little bit more liability sensitive than most banks are. And in this current environment, I prefer the bank to be a little bit more asset sensitive. So part of this, as we noted, the securities portfolio has pretty long duration. Only about 2% of their securities reprice within the next year. So there's basically no help from the asset sensitivity of the securities and neutralizing the asset liability risk, right? So, and then we also saw that the debt, the entire amount of the debt reprices within the next year. So the FHLB and Bank Term Funding Program amounts, which was $3.9 billion, as well as the trust preferred securities reprice and repurchase agreements reprice, all of that within the next year. So that's a big risk. And the only thing that's really saving us on the liability side is the deposits. If you remember, there's 33% of deposits are non-interest bearing, so those don't reprice, right? So that leaves only about 66% of the deposits that reprice within the next year. That includes the time deposits that reprice in the next year, as well as like savings accounts, money market accounts, etc. So that's a pretty average amount, if not on the low side. So that's helping the asset sensitivity of the bank. And then by looking at the loans, about 34% of the loans reprice within the next year. So that's pretty average. And that's actually pretty good. So all those things together, the securities, none of the securities reprice within the next year. About an average amount of the loans reprice in the next year. All of the debt reprices in the next year, but it's only $3.9 billion, right? And maybe 66% of the deposits reprice in the next year, and that's a pretty average amount. So about an average amount of assets compared to liabilities reprice over the next year. So that puts us at about an average of where the normal bank reprices at. But currently, most banks, or the average bank, is a little bit liability sensitive, which, I prefer the banks to be asset sensitive, but it makes it to where this bank we're looking at right now, its net interest income would have the same effect as the average bank's net interest income effect would be with any change in interest rates. So if we're comparing our current bank to the entire market of banks, then our bank is the risk is average to the average bank, right? So I think we have to say that the interest rate risk is average. There's, continuing on, there's no board-approved repurchases of stock. And so now we get down to the bottom of things. So we can bring all these things together and try to decide whether this is a good buy. So we saw that the bank is very, very profitable currently, right? So return on assets of 0.95%, which puts them at an average return on assets. And that's partly due to the net interest income being very, very good due to having a lot of non-interest deposits and non-interest bearing deposits. But then they've got a little bit less non-interest income than the typical bank, but also less non-interest expense. So it puts them at a very average return on assets. And so speaking to a little bit of the risks of keeping that income the same, because what we're trying to do is we see how much the bank is earning currently, and we want to see, well, how likely is it that the bank is going to continue making that much money, and that determines how much we're willing to pay for those earnings, right? One of the things to think about, so if you're looking at the earnings yield or the price earnings ratio, there's a couple of components that go into it, right? It's the risk. I'd be willing to pay less money, or I'd be willing to pay more money for a bank if it has lower risks, right? Because I'm a little more certain that those earnings are going to be consistent. I would also be willing to pay more for a bank that is growing because those earnings are likely to increase, right? So, one of the things to think about, and that we typically don't look at too closely because it's just too hard to predict, and I can't predict the future, right? So the growth of the bank. Now, its location is Washington and Oregon, which currently is projected to have really high population growth over the next 20, 30 years. It's probably one of the highest growth projected areas in the U.S. And of course, when you're a bank, a lot of the growth is dependent on population growth. That's a kind of a key qualitative factor. So that's something that you could hang your hat on to say, I'd be willing to pay less for this bank because I'd be willing to pay more for this bank because it might be growing further. And then on the flip side, we have the risks, right? So we talked about the credit quality. We saw that they don't have very much past dues or non-accruals, TDRs, collateral dependent loans. It doesn't appear that the portfolio currently is in a bad place. But whenever you take into account the classified loans, which are the substantive or the substandard loans, loss loans, that amount seemed to be a lot. It was almost 1.6% of loans, and that's a pretty high percentage of loans. So that leads us to think that there could be some forewarning or identified problems within the loans that haven't yet appeared as slow payers or customers that needed their loans adjusting, or the terms of them adjusting just yet. So we went into detail about considering, well, what would be the effect on the income statement if the bank needed to add to their provision or write off more loans, because all of those things would hit the income statement if down the road they needed to increase that provision, right? And we saw that in order to keep their return on assets within a normal average range, they could increase the provision by $20 million over a period of a little more than 8 years. And that would make the reserve equal what the classified loans is, while at the same time keeping the bank within a normal average profitability. But I feel like that runway is a little too long. And there could be a risk that they need to increase the provision by a larger amount sooner. And in that case, it would put the bank into a return on assets or profitability metric that is below the average. And in turn, if the market price stays the same, that makes the earnings yield decrease as well. And I feel like that the risk is too much to justify an average earnings yield. But we did see that the bank was earning 11.75% on its earnings yield, while most banks earn somewhere between 9 and 11%. This bank's earning almost 12% based on its market price. So its price is a little bit cheaper than what we would see for most banks, and perhaps it's to compensate investors for the risk that a higher provision is going to need to be put in place down the road. So we probably could make the case that, all right, I'd be willing to pay the current market price to earn almost 12%, with the understanding that I have that risk that the earnings might be a little bit lower in the future. But even if that's the case, my earnings yield is going to still be within a normal average range. So that's the credit risk. Now, then we enter into the capital risk. So we saw that when we convert the assets and liabilities to fair value and compare a tangible fair value of net assets number to the fair value of assets, we get a pretty low ratio. I think it was like 4%, which is below what we normally see. We also had pretty low tangible common equity ratios, pretty low regulatory ratios. So it's really apparent that they don't have the amount of capital that most banks have in place. So I could see down the road they would need to raise more equity, which would dilute the current, I guess there's a couple options. They could either raise more equity, which would dilute the current shareholders' earnings and the earnings per share, etc. They could not pay as much dividends as they would if they were a little bit better capitalized, which would probably be the more likely scenario, just not increase their dividends as much down the road. We already see that they don't have, the board hasn't approved a large amount of share repurchases, which we see almost all banks have share repurchases in place. So, so all those things decrease our return that we get out of the investment, right? And then, if it's not equity capital that they want or they're concerned about, they could possibly have to borrow more from the FHLB and the Federal Reserve, which they can. We saw that they've got a lot of liquidity in place, and that they also have off-balance sheet liquidity. So they could possibly need to borrow a little bit more at some point, which would be at higher yields now than perhaps what they had a year ago, right? So that's a risk to earnings as well. So I feel like that is something that also decreases the price that we would be willing to pay for the bank, because we're entering into that risk that either they're going to need more equity capital, and adding more capital would decrease our earnings, or they might need more debt capital, which also adds to the interest expense. So those are two things that really hit our earnings and require us to have a lower stock price. But the two things being liquidity risk, but also the loan credit quality risk. Our third risk is interest rate risk, which we saw is, in their disclosure, is very neutral risk, right? No matter which way the market interest rates go, the net interest income pretty much stays the same. In our own calculations, we saw that the bank, its asset liability structure is pretty average with the average banks, within the range of what a normal average bank would be. So that leads us to believe that their interest rate risk is about average. I do think that it's a little bit on the liability side, which would mean as interest rates increase, or as the liability side of their balance reprices, which we saw it reprices pretty quickly, then they would need to be paying more interest expense, paying higher yields on that interest expense. So that also hits our net income. So what we have here, I think, is all three of the risks: the loan quality, the interest rate risk, and the capital risk, all have a few dings. Now, we also have a market price of the bank that gives us a higher earnings yield than what we'd have for the average bank. So then we have to think to ourselves, is that 11.75%, 12% earnings yield enough to compensate us for all of these other risks that we have, that at some point the bank is going to be making less money, either because they have to create a higher provision, or because the liability side of their balance sheet reprices and they're paying more interest expense, or they need a little bit more capital, so they need to borrow or issue new shares. So those are all very real risks to us that the 11.75% might not be enough to compensate for. And another thing to think about is those lawsuits that are in play. We know that's going to eat into things as well. I don't know how much they would end up having to pay attorneys, or how much they might, they could possibly lose the case and have to settle or anything like that. So, currently they're making $124 million a quarter. Paying attorneys and all that stuff can really add up to a lot. So, if our credit quality is down, the difference between the classified loans and the reserve is $176 million, and there could possibly be $20, $40, $60 million on these lawsuits that they have to pay. Who knows? There's additional interest expense when they have to borrow a couple $1 billion or whatever happens. But those are all very real risks that are going to eat into that $124 million a quarter that we're making currently, which seems like a lot of money, right? So all that to say, I don't think that I would buy the bank at this price. Yeah. I'm not really sure at what price I would buy it for these risks and at these earnings. But, another thing to think about is that the price for the fair value of the net assets was pretty high too, like 2.21 times. You'd be paying over 2 times the fair value of its net assets at the current market price, which is also pretty high. So I feel like there's banks out there that have pretty average normal risks and pretty average or better prices to buy the earnings for and are making good money. So I'm going to err on the side of allocating my capital to those banks instead of this one. So that is my conclusion. And, definitely let me know if there's anything that I missed or you want to clarify, or whether there's any flaws in my logic or data or analysis. Definitely let me know. Love to hear what your thoughts on, whether you would buy or sell the bank, or what you like or dislike about it. Let me know. So anyway, thank you very much for listening.